So we're still working with the roadmap. You've got it out. And we looked at the symptom, low gross margin. Now what we want to do is going back to our original roadmap, we want to take a look at another one of the symptoms. Farther up toward the top, it's the low or declining cash, right? And we want to work against the arrows, as we've been doing all along. Low or declining cash is caused by. So if you come out of the top of that box, you immediately come to a T in the road, don't you? Out of the top of that box, you can turn right or you can turn left. Turning right, low cash is caused by, what are the first two things we come to?
Too much inventory.
Too much inventory and or too much receivables. When I say and or, not everybody has both inventory and receivables. And as I said earlier, if you don't have both inventory and receivables, do not feel cheated. It's okay, all right? Now, too much inventory. Low cash is caused by too much inventory. Off your ratio scorecard, your report card, what are the two ratios, what two numbers are we going to write up by that too much inventory box? 9 and 10, right, 9 and 10, that's exactly right. And moving over to the accounts receivable box, too much AR, if you will, what are the two numbers off your ratio report card that we're going to write right above the too much AR box? 11 and 12, that's exactly right. You with me? Okay. And of course, going back to the low cash symptom box, what were the two ratios that were giving us the clue that in fact we have low, and in this case, and declining cash? Numbers 1 and 2, that's exactly right. And if we come up out of the low cash box is caused by, and we turn left, what's the first box we come to?
Liabilities.
High current liabilities, right? Okay, well that's going to be the second piece we look at. What we're going to do is we're going to come up, and for purposes of this section, we're going to turn right. Okay? Low cash is caused by too much inventory and too much receivables. Now we know that we've got too much inventory out of ratio number 9. How do we know that? He's getting how many turns on his inventory? 4.2. And the competition, the group, his industry, what are they getting? 4.9. So he's out around by 7/10 of a turn, isn't that right? And if we drop down one and we converted it to days, he's turning in 86 days, and the industry's turning it in 74 days. He's out around by how many days was it again? 12 days. And of course, if it takes 12 days longer, it means it's turning what? Slower, and therefore he has more. What's the question we need to answer? How much more? How much more? Well, to do that, we just need to do a little bit of a calculation here. A little bit of an inventory analysis. Cascade, I've just put up the information we know. 4.2 turns, the industry 4.97 of a turn. 86.74, 12 days. Now let's go back to the formula. Let's go back to the formula and create a too much inventory calculation. You with me? Okay, so cost of goods sold, ratio number 9. What's the formula? It's in the third column there. It says what? Cost of goods sold divided by what? Inventory is equal to turnover. You with me? Okay, now, all we're going to do is flip this, so this is a little bit of math thinking here. So we'll take cost of goods sold divided by inventory turnover has got to equal inventory. And if we say cost of goods sold divided by target inventory turnover, that would give us what? Target inventory. Exactly. You with me so far? Make sense? All right. Well, we know that off of his income statement, his cost of goods are what? Off of his income statement, what are his cost of goods? $1,760,000. So that is his cost of goods. And off of our ratio report card, he's getting 4.2 turns in ratio number 9. We'd like to see him get what? Be at least as good as who? The median of the industry, huh? The median of the industry. So $1,760,000 divided by the target of 4.9, if you use your calculator, you'll come up with what I came up with. He should be carrying 359,000. Are we agreed with that? Okay. Now what we've got to do is take a look at how much he actually has. So you're with me on the calculation. 359 is what he ought to have. Now check out his balance sheet under inventory, and how much does he have?
419.
419. So how much, too much, does he have? $60,000 too much. So if it wasn't there in inventory because he's turning it too slow, and there could be a lot of reasons for that. He's buying the wrong stuff. He's buying too much of it. He's not taking a look at what's selling as well as what he believes will sell. Maybe his marketing and promotion is not advertising the right things. A whole litany, a whole list that we could make up as we went through. And actually, this is something you'll discuss with your facilitator as well as we go through this program. $60,000, if it wasn't there sitting in inventory, where would it be? In his pocket, actually in his checkbook, hopefully not his pocket. It would be in his checkbook. So this 60,000 excess, now we've got to give it one of two letters. What are those two letters again? P or a C. Okay, inventory shows up, you just looked it up, on which financial statement? The balance sheet. That would mean that the primary impact is where? P or C?
C.
C, it's a cash impact, isn't that right? So $60,000 cash would be sitting in his pocket if it wasn't in his balance sheet, in his checkbook, if it weren't there sitting in inventory. And we know that he was out around by 12 days in ratio number 10. You with me on that? $60,000 is the excess spread over 12 days. How much is 1 day of inventory management worth to this gentleman? $5,000. Now, I can't tell you, when we talked earlier in the section, we talked about turns are days, days are time, and time is money. Remember that? Well, now we've translated those turns into what? Dollars. I don't know about you, but it's always been true for me that $5,000 has a lot more meaning than 7/10 of a turn or 12 days. $5,000 per day, I can understand that. Why? Because I've got $11 in my wallet, and I know what $5,000 is. And I think most of us have the same approach to things. That's surprising to most of us, most business owners, that we take a look at this case, they're going, geez, I never would have guessed. Well, the interesting thing about Profit Mastery is we don't have to guess. We can actually measure all of these things with the metrics that we're developing. That's really what the value is, all right? So what we've done is we've taken ratios 9 and 10, too much inventory, and now we've actually given it a value, $60,000, and we've labeled it P or C?
C.
You got a 50-50 shot here still. C, it's a cash impact, all right? Now let's take a look at would the same concept apply to receivables? It's money tied up until they pay you, isn't that right? So maybe the same concept applies. So let's take a look at our AR numbers. Ratio, and what ratios were they again? 11 and 12. Ratios 11 and 12. So when you look down ratio 11, do you remember he was only out around by what? Half a turn, isn't that right? Half a turn, 8 turns to 8.5 turns. Half a turn sounds like what? Barely nothing. And if we drop down a little farther, it was 45 days and 43 days. He's only out around by 2 days. Well, gosh, what can 2 days mean? Well, now we have the ability to calculate it, don't we? So I've put up our information here. Cascade 8, Industry 8.5, half a turn. 2 days, all right? So let's do the same kind of a calculation. Let's do the same kind of a calculation, And I've inserted one word that's slightly different that I want to be clear on, just because not everybody makes all their sales on credit. There's a lot of businesses that have some cash sales and some credit sales. So the formula in ratio number 11, check it out, third column. Sales divided by AR is equal to turnover. And I'm adding what word? Credit sales. You might write that in as well, credit sales. And the point is what here? Credit sales, if we count cash sales, what's that going to do to our number? It's going to skew it and make it better than it really is, because you got that money. You don't have to worry about collecting it. So credit sales, now we're going to do the same kind of little mathematical switcheroo here. If credit sales over AR is equal to accounts receivable turnover, then clearly credit sales divided by turnover must equal AR. You with me on this? We just flipped them. And then credit sales divided by target turnover must equal what? Target AR. All right. So we remember that all of his sales in this particular case study were on credit. He didn't do any cash business, so we can use the whole number. And the sales off the top of your income statement were $2,160,000, and we'd like to see him get how many turns in ratio number 11? Not 8, but in fact what? 8.5. So we divide that out and we get, well, what do we get? I got 254. Hopefully you get the same thing. $254,000, right? Okay, now take a look on his balance sheet under accounts receivable. What does he have? And circle this, the number. In his current year, year 3, what does he have? 270. He's got 270. So how much, too much, does he have if we compare him, not remember against the good guys, just against who? The median, the middle of the road. $16,000, 270 minus 254, $16,000 tied up in AR. You with me on this? If he could turn it just as fast as the industry, and that, by the way, somehow, oh, let's just finish this. And that was how many days he was out around again?
2.
Now, you shouldn't need a calculator for this one. $16,000 excess, 2 days. How much a day? $8,000 a day. So for every day he can crank in his receivables by 1 day, it's like somebody handing him what? $8,000 of cash. And correspondingly, for every day that it goes the other way, it's like somebody doing what? Sucking $8,000 right out of his pocket. Once again, I don't know about you, but it's always had a lot more impact on me. If you say 1 day, you're going, blink, you know? You say $8,000, I'm going, oh, okay. Now, if we could do, in other words, what we're talking about really is improving this business 1 day at a time. Give me a day of, I don't expect him to go bam and get 12 days, and maybe even bam and get 2 days. Let's just start improving it 1 day at a time. Give me a day of inventory. How much is that? $5,000. Give me a day of receivables. How much is that? $8,000. $8,000. New math. Total. Give me 1 and 1. How much is that worth in additional cash? $13,000. It's Friday afternoon. He's at the bank. He needs $13,000 because he doesn't have it. What does he need it for typically on Friday afternoon? Payroll. He doesn't have enough money for payroll. I just need enough to get me over the hump. $60,000 in inventory and $16,000 in receivables, $76,000. If he had that today, magically, what could he do with it?
Make payroll.
Make payroll. What else? He could pay down his debt, maybe. Do you remember how down in ratio 14 how many days he was taking to pay his payables? 63 days. Maybe he could stop the phone calls. Maybe he could actually pay them. Then they wouldn't have to call him. I mean, he'd have all kinds of choices, wouldn't he? There's always something to do with money if you've got it. Everybody wants a piece of him, and all of his money is sitting where? In his balance sheet, and he can't access it. It's tied, it's locked up in the balance sheet because he hasn't been able to manage it efficiently. Squeeze it, if you will. And we'll talk a little bit more about that later. You with me so far? Yes. So we've got $76,000 here in our roadmap. Now there's one other piece I'd like you to take a look at because it's relatively important as well. On your roadmap, go out the bottom of the low inventory and low receivables box. The lines will link up and follow it around. In the direction of the arrow, we still use the word causes. And what are we going to get? Too much inventory and too much receivables. Causes what? High hidden cost. What are some hidden costs? In inventory, yeah, we'll track interest separately because it's so visible. But what are some of the hidden costs?
Real estate and labor.
Labor, handling. In some states, there is an excise tax on inventory. There's about 20 states. What else? Obsolescence, meaning what? It gets old. Breakage. Theft. Who steals again? Everybody? Now, the one thing you can count on is if they break it, they probably will not steal it. Most thieves are smarter than that. They don't want broken stuff. They will just do what? Leave it somewhere. All of these hidden costs, and why do they call them hidden costs? They're not there in any visible way. Are they real? Absolutely real. Absolutely real. The accountants and the financial industry tells me, and I believe this, 2% per month on all of those hidden costs. And as it relates to receivables, what are the things that add up there besides interest? Because, as I said, we'll track that separately. Collection. If you can't collect it. Bad debts. All of the time and energy. Turning it over to an agency if you have to collect. Then they're going to charge you a fee, aren't they? A contingency kind of fee. Although same cost, 2% a month, 25% a year, just with a slight rounding there. So how much excess do we have? And we'll track that by just coming out the bottom, tracking it around down to the high hidden cost. So this $76,000 is really creating a cost, isn't it? Inventory, receivables, $76,000. Hidden cost, 25%. We won't be able to put our hands on them. There's not a line item on our P&L, is what Zev said. Basically, there's no line item that the accountant puts on our P&L that says the hidden cost of too much inventory, right? If you abbreviate it, dichotomy. You're never going to see that, but it's all there, isn't it? It's really there. Those are going to be something we incur. What does it translate into? How much? A quarter of $76,000, $19,000. So we're going to put that right by our box labeled high hidden cost. $19,000. Now, we still have to pick a letter. It was the cash tied up in inventory and receivables, but it says hidden cost. Where do costs show up on our financial statements? Which financial statement?
Income.
The income statement. Well, if this cost shows up on the income statement, what letter are we going to use?
P.
P. We're going to use a P. It's reducing our profit. And that's already been reduced enough. You know what I mean? We could use this, all of these little pieces, all of these little things that we're talking about here, some of them not so little, are going to do what? All these little things are ultimately going to add up, aren't they? They're ultimately going to add up. So what we've done now is we've summarized essentially from the symptom of low or declining cash is caused by too much inventory, too much receivables. We summarized that into $76,000 total cash impact. Out the bottom, causes high hidden costs. You with me? $19,000 profit. All right. Now, when we get back together, we'll come out of the low cash box going against is caused by, but instead of turning right, we'll turn left. And we'll take on essentially the financial side of our roadmap, the financing side of our roadmap.